Hey fools, Max Macaluso here with Senior Analyst Michael Olson. So Michael, in addition to working on our special ops and MDP services here at the Motley Fool, you also run your own real money portfolio.
Right. Mm-hmm.
And one of your more successful picks has been WellPoint. So this is a stock that you picked about a year ago. Mm-hmm. It's up about 50% since you picked it. So with all the changes going on in the healthcare space with the Affordable Care Act, let's talk a little bit first about why you picked it last year.
Right. So I think that sort of gets to the heart of why I picked it. There were really two critical issues going on here. The first was that WellPoint was sort of a serially undermanaged organization where they had all of the sort of key characteristics you would want to see in a successful managed care organization: economies of scale, network effects, the ability to negotiate favorable terms with providers, and yet they were not really performing the way you should have. And so my hypothesis was that this was an organization which was mismanaged, but the fundamental sources of their competitive advantages had not eroded. Health insurance, and basically insurance writ large, is a mean reverting sort of return profile. And their returns were really on the lower end of that spectrum. So I expected that those would be remedied. And with the entrance of the new CEO, Joseph Swedish, the market certainly has confidence that that is the case, and the results have borne that out this year. The second factor was that people were very concerned about Obamacare and the extent to which that would impact margins. My hypothesis there was that, the stock was indeed priced for that. If you were to look at a lot of what the not-for-profit managed care organizations had done in terms of their profitability and use that as a proxy for WellPoint's profitability in a worst-case scenario, they were indeed priced for that. And my hypothesis was that you were going to go ahead and see them do a little bit better than that in some of their lines of business. The last was the AmeriGroup acquisition. I thought that was a pretty savvy deal where it gave them access to a part of the market which is likely to see a lot of growth under Obamacare.
Right. So let's talk a little bit more specifically about Obamacare here. So the exchanges rolled out at the beginning of October.
Right.
And if you look at how WellPoint stock did, I mean, it was up more than 6% since the start of October. So the market clearly wasn't too worried about the slow enrollment that we've seen and a lot of the finger pointing around the healthcare.gov glitches. But with enrollment being slow and enrollment numbers being far below projections so far, does that give you cause for concern?
Sure. So I think with respect to WellPoint, they're going to be one of the key beneficiaries of the Affordable Care Act. Writ large, I think it was maybe a slightly net negative for the managed care sphere, but WellPoint really has key capacities in the individual insurance market, and they have a strong brand equity in the Blue Cross Blue Shield name. So that really positions them favorably to go ahead and capture share, in my opinion. The other thing they really have working for them is they have a lot of expertise in negotiating narrow network health insurance policies or health insurance networks. And that's particularly favorable when you think about going ahead and getting high profitability on a per policy basis. So, right now when you start to think about enrollment being slow, whether or not WellPoint's going to benefit or they're indeed going to be hurt, I don't think that there's necessarily much cause for concern here. And the reason I think that is the case is if you look at a lot of the rates that insurers are charging on the exchanges, it looks like what they did was they went ahead and got out in front of the possibility that young people might not enroll on the exchanges. They were going to be very profitable policies in a measure which you might have expected. And in turn, because they basically have a legislatively mandated cap on their profitability, they said, you know what, we're going to go ahead and price this business really high because, if worse comes to worse, we'll just go ahead and rebate the excess. But if young people don't sign up for the exchanges, you know what, we're kind of left holding the bag here. And that's not a good situation. So when you think about the large managed care organizations, United Health and WellPoint, I think they're going to do okay in all of this. United Health in particular, they're the best-in-class insurer. They historically have been just an incredibly well-managed organization, and they really never seem to miss on underwriting. I own the shares. I've been a very happy shareholder.
Okay, so going forward, you still like WellPoint and United Health?
Yeah, I mean, I don't think WellPoint is near the value it was a year ago. But at 10 times earning, it's really not an astoundingly expensive stock either.
Right, and we know that you're a value investor, kind of a deep value investor, so we can take your word on that. Michael, let's talk a little bit about the enrollment numbers. So numbers came in yesterday, 365,000 individuals enrolled in October and November, so far below the projections, but folks still have until the end of March really to enroll before they face a penalty, right? So here's a question as an investor. If by the end of March, we still don't see very robust enrollment numbers, are you going to panic, or are you waiting until 2015 to really see how things shake out here?
I think that just kind of to the point that we were discussing before, you're not really panicking this year, just because what I think insurers did is they really got out in front of the possibility that young people were not going to enroll in the exchanges. There is indeed the lingering concern of this sort of death spiral that people discuss, where the young people do not enroll, insurers cannot increase their prices at a high enough rate, and the profitability suffers. That, or you see dramatic healthcare cost inflation.
Right, and that's because your pool is getting riskier, so in order to offset that, you're going to have to increase premiums, and then the cycle continues year after year. That's a concern.
Exactly, and what I think on account of the systemic reliance on managed care organizations still, what you're going to see is you are either going to see these companies increasing rates, or you're going to have young people enrolling. With respect to the legislation and it accomplishing its intended end, you really need to see that participation en masse, and particularly from young people. Otherwise, I think you're going to go ahead and continue to see healthcare cost inflation. With respect to the insurers, my personal belief is that their return profile is not going to be dramatically affected by this. Certainly, the legislatively mandated caps on profitability really aren't that much. It's not that much worse than what they were doing before from a return on equity standpoint. And you can say whatever you will about that from a social standpoint, but from an investing standpoint, there's not much to worry about there.
Right. So as an investor, how far out do you kind of look when you're examining companies like this?
I mean, I think you're trying to think about these companies on a 5 to 10 year basis. And admittedly, there's a bit of a challenge in the healthcare sphere in doing that, because regulation plays such a critical role. I mean, I think you and I were talking about this a couple of weeks ago, and basically whenever you see high margins or high returns on capital in the healthcare sphere, you immediately want to be a little bit scared, just because they're going to be the legislative crosshairs at some point or another. And in this case, you know, I think what we are looking at is we're going to be looking towards the 2015-2016 corridor to see really how things play out with respect to the ACA, Obamacare, and the prospective impact on a lot of these companies. I think we can speak in generalities and economic truisms, but obviously regulation and legislations do not necessarily adhere to that.
So, Michael, we talked a bit about the insurance industry, but let's look more broadly at healthcare, because when we talk about healthcare, we have to look at patients, providers, payers, and also other sub-industries under this umbrella, right? You have drug makers, biotech companies, pharmacy benefits managers. So when you're looking at the Affordable Care Act and its impact on the industry, what are some winners here and what are some losers?
Right, so I think with respect to the winners, broadly speaking, I think the PBMs, the pharmacy benefit managers, have been a net beneficiary in this.
And actually, Michael, this is an industry that not a lot of people, not a lot of investors really know about. And I have to be honest, I didn't know much about it until I started digging deeper into healthcare as an investor myself. So can you just give an overview of what PBMs are?
So what the PBMs do, and it's really kind of an interesting sphere, the way I like to describe them is they are maybe like an Amazon or Costco to the pharmaceutical supply chain. And so what they do, just like Amazon and Costco will go ahead and they'll go to vendors and say, look, we're going to give you access to a lot of consumers. And what you're going to do as a cost of that is you're going to give them really, really low prices. Otherwise, you know what? That's going to suck for you. Right. And so the pharmacy benefit managers, they basically, you've seen widespread consolidation within the industry to the point where maybe 60% of shares held by 3 players. Express Scripts, most notably, they're the largest 25% share. And so what they do is they say, look, we're going to give you access to all of this insured population. And what you're in turn going to do is you're going to give them lower drug costs. And so what they'll do is they will facilitate, they basically manage the entire pharmaceutical supply chain. They sit right at the intersection of the insurers, the pharmaceutical companies, the drug distributors, and the pharmacies. And so they work with all of these folks to go ahead and A, administer the prescription benefit plans, and B, make sure the costs are most preferential for the consumers. In exchange for that, what they do is they basically take a few pennies for each prescription that they fill, maybe 4 or 5 cents.
Right, and also the generic drugs that have been coming on the market have also been a tailwind for them, right?
Sure, because basically what ends up happening is there's competition, and in turn they're basically able to extract better terms in exchange for pushing a given drug. So it's kind of a net win-win. And from a policy standpoint, the pharmaceutical or the PBMs, they really do kind of a net good because they are lowering prescription drug costs, and they are also promoting preventative care here. So if you're to think about this from a kind of a 10,000-foot view, there are 2 ways you can go ahead and deal with your health issues. You can either go to the hospital when something is really bad or you have a chronic condition, or you can take drugs and really get in front of that. In terms of the relative cost, these are much cheaper, and they have there's the capability to prevent future issues or issues down the line.
Right. So, Michael, specifically, when you look at the ACA and its impact on the PBM industry, why do you see some benefit here?
Right. So, I think you see a benefit, most notably in that you're going to have 30 million insured, which were previously not in that pool, and so obviously that's going to drive higher prescription volumes. Looking out across the longer term, you have some secular tailwinds, and basically, so the average 60-something, they consume about 5 times the number of prescription drugs that the average 20-something does. Now, as we're all well aware, we as a society are getting much older. And so I think that it's not inconceivable to think that you're going to see maybe a 50 to 75% increase in prescription volume over the course of the next decade. The last thing that I think is very interesting within the context of the ACA is there is obviously a huge sort of push to bend the cost curve. There's one thing that PBMs are uniquely qualified to do with respect to bending the cost curve, and that is mail order prescription fulfillment. Right now, about 10% of prescriptions are filled via mail order. It's cheaper in aggregate because what happens is you're going ahead and you're eliminating the middleman, the pharmacy company. Or I'm sorry, not the pharmacy company, but the pharmacy. And in doing so, PBMs are also making much more in the way of profits. Perfect example of this, I was doing some math on Express Scripts the other day. If they were to grow their mail fulfillment rate from 10 to 15%, it could amount to a 40 to 50% increase in operating profits, all else equal.
That's huge. Right, so you're expecting margins to expand in this industry.
Right, absolutely. I mean, and in no small part because this is a scale business where it's a very capital light business, and to the extent, each incremental prescription that you add, you're not adding much in the way of cost within the core business. And so as they grow, they're able to go ahead and more effectively execute on their mission, which is to negotiate low drug costs. And in addition to that, the incremental return on each prescription is great.
Right, and even within this industry, you have companies with different business models, right? You have Express Scripts, that's kind of the classical PBM, and then you have Catamaran that's working in a little different way, right?
Right, exactly. So what they're doing is they're trying to go ahead and give a more transparent pricing on this. Sort of an ongoing source of contention within the PBM industry, and I should say between the PBMs and pharmacists, is that the PBMs are not in fact executing on their missions, and instead they're gouging the pharmacists. And Catamaran, they've kind of gone ahead and turned that model on its head and said, you know what, we're going to be completely transparent with this on our pricing, and it's been relatively successful for them in that they've, following the merger with SXC, they've emerged as a strong number 3 within the industry. That being said, the Express Scripts and Catamaran, they're kind of servicing different populations, where Express Scripts is going after the customers of scale. Because some of these smaller customers just simply don't move the needle for them, and it doesn't make sense from an economic standpoint. Catamaran, they're able to go ahead and be sort of the scrappy number 3. I mean, that's kind of a funny thing in an industry where it's a multi-billion-dollar industry and 60% of market share is held by 3 companies, but they still are sort of the scrappy 3. But they're large enough that they can go ahead and negotiate favorable terms. They did about 250,000 prescriptions last year.
That's impressive. Right, so the Affordable Care Act and PBMs, we covered that. Let's look at a potential loser from the Affordable Care Act.
I think of the prevailing sort of belief at the outset was that the hospitals and providers might be net beneficiaries here because of the expansion in volume, and hospitals in particular because they had more transparency surrounding their bad debt expense. One of the the hardest parts of being a hospital in the previous sort of whatever the working order was that if people didn't have insurance and they got sick, they could show up at a hospital and you had to provide care for them. That was legislatively mandated. And so hospitals had no transparency surrounding their cost structure, and that contributed to the healthcare cost inflation in a pretty dramatic way. If, as many fear, you don't get full participation in that network, or in the ACA.
In the exchanges, yeah.
Right, in the exchanges, what you're probably going to see, or you might see, is hospitals are still going to have this very same problem, but there's even less they can do about it, just because they're only going to be able to push back on the insurers to a certain extent. At least that's what the concern is. That was a bad business before, and it's still not really a good one. That's the short of it.
Right. It sounds like there's still quite a bit of uncertainty there. So I know most hospital stocks have been on a tear for most of the year in anticipation of getting more people on insurance, so that
and more transparency surrounding their cost structure. Yeah,
exactly. So I guess we have to see how it shakes out long term.
I'm not a fan of them. I mean, I think there certainly is a circumstance where you could have made the argument that these stocks are cheap, but they're no longer as cheap as they were. And in addition to that, I think there is some uncertainty surrounding how this is actually going to play out for them.
Right. Okay, let's turn to one last issue here. So we talked a lot about the Affordable Care Act and how it's impacting different industries, but let's say an investor out there is looking for some exposure to the healthcare industry, but wants to invest in an area that isn't necessarily directly affected by the ACA. So what industries would you steer them toward?
Right. So I think this is kind of like the one remaining secular growth story within the healthcare industry that is by and large not really impacted by the ACA, and these are what you'd call contract research organizations. And basically what these companies do is they provide outsourced R&D for the pharmaceutical companies. You and I were talking about this a couple days ago, where what you have here is there's been sort of an ongoing shift in the pharmaceutical companies model, where previously these were science companies where they did a lot of R&D and they brought drugs to market. And increasingly, their core capacity is not so much science but distribution, where they're not so much trying to go ahead and develop these drugs as they are more private equity firms, and they try to bring drugs to the market. And so basically there's been an increasing focus on efficiency in these R&D dollars. And what the larger contract research organizations are able to do, and particularly in the late stage end of the business, is they are able to provide expertise, they're able to provide access to patient populations, they have knowledge and experience navigating these regulatory pathways. And in addition to that, there's really, these are multi-billion-dollar endeavors. And so you want to make sure you get with the right organization here. And so what you've seen as a consequence of this is maybe 4 or 5 CROs in the late stage end of the business have emerged as key players. Among the publicly traded, there's Parexel, Icon, which is also in my real money portfolio. You have Quintiles, which recently came public again, and Covance, and they kind of play in the early stage and late stage end of the business. These companies are uniquely advantaged in that they are players of scale within the late stage business. And what that's enabled them to do is win a lot of business and continue to win business with the pharmaceutical companies. And what you've seen in recent months, or I shouldn't say months, but years, is an increasing shift towards sort of a partnership model where the pharmaceutical companies, they don't necessarily think of these companies as vendors where they're performing a service so much as they do strategic partners and a stakeholder. And you've seen a lot of strategic partnerships between the pharmaceutical companies and these large CROs. Right now, penetration in the industry, the CROs basically get maybe, depending upon who you were to ask, 30 to 40% of R&D dollars. I think that you're going to see an increasing trend towards outsourcing these R&D dollars, in no small part just because the CROs are a whole lot more efficient than the pharmaceutical companies at moving a drug towards approval. And as soon as you go ahead and you put that drug in for patent approval, the clock starts ticking on that. So even a couple months is a big deal right there. I think what you're going to see in the late stage end of the business is sort of a winner-take-all dynamic where companies like Parexel, Icon, Quintiles, and Covance, they will win an ever an ever-increasing share of those contracts. I think they can probably grow at a double-digit rate on revenue, absent any sort of meaningful growth in R&D dollars for the better part of the next 5 to 10 years. So that's pretty attractive right now. You know, stocks are not cheap. They're writ large, trading at or around 20 times earnings, but that's not altogether unreasonable if you're to consider the prospects for this business and the fundamental attractiveness of the moats in the large players.
Right, and I would say as investors start reading through some of the filings, look out for royalties, right?
Sure.
A lot of them get a chunk of royalty if they're successful in developing a drug with a bigger company. And also, one last thing to note is that, you know, not every pharmaceutical company is big on outsourcing, right? You have like GlaxoSmithKline that's really trying to innovate and has a very unique R&D platform, but I would say they're more the exception.
Right.
Most of the big pharma companies have been criticized for their ballooning R&D costs. So, like you said, one way to shrink that quickly is to just outsource it to someone that has expertise. So,
Right.
Great summary of everything going on in the healthcare industry right now. This is a lot of fun. I think we should have more conversations about
Absolutely, that's great.
Once again, if you're interested in following Michael Olson's Real Money Portfolio, you can find it at fool.com, along with other stock analysis. Thanks for joining us.